and welcome to the Ideal Wealth Grower YouTube channel. What we are talking about today is what are the benefits and why would you as a real estate investor potentially consider investing in international markets. So if you are in the United States and you are used to investing in the United States and you have listened to what we are actually suggesting with our out-of-state turnkey strategy in markets where you find performing properties, you can build a really nice, well-developed passive income portfolio of anywhere between 10 and 20 properties, something like single family, duplex, triplex, fourplex, get them normally financed with FHA loans. Every person in the US can get up to 10 of those. So if you say, okay, I have my own residence finance and then I get 9 and your spouse gets another 10. So you can have 19 properties all financed with government insurance backing, normal rates, 20% down, 80% finance, all good, all well. One thing that anybody who is in investing will always tell you, whether it's investing in real estate or investing in the stock market or investing in other things, is you want to get diversification. And one reason for diversification is to mitigate risk. So how does international real estate investing mitigate the risk? One thing that we are all experiencing right now is pretty significantly growing and rising inflation. So that is one thing. Prices are increasing. That's what we see in inflation. But there's also another aspect to consider, and that is supply and demand. And what we are facing in the United States is not only rising prices, but also the fact that there hasn't been enough new building of infrastructure, new building of housing for probably a decade at least, probably more than just a decade by now. And every year we need about 1 million new housing stock to be built, partially because a few properties are falling out of the inventory, but also because in the United States, as one of the few countries in the world, in the Western developed world, the population is still growing, partially because the birth rate is a little higher than in other places, but also because there's a pretty substantial amount of immigration, people coming into the country, living in the country, getting work permits and green cards and citizenship and all those kind of things. So the population is rising, which means if there are more people, there is new housing, more housing required. But if there isn't any built, that means the growing number of people is chasing after a smaller number of available houses, which leads to additional increase in prices. So it's harder and harder and harder to find properties that are actually performing anywhere close to the 1% rule that I've talked about many times. So how does that relate to the international markets? Now, one thing is the more exotic the place is that you're willing to consider for your real estate investing outside the country, the less you have to pay, the less of those pressures you are exposed to, but also because of real estate markets are in most cases local markets. So if you take an example, you go to a place, let's say some country in the Caribbean or something like that, where the average prices of all the houses there is $150,000 to $200,000. Well, that means even the nicer houses that you would maybe consider are probably in the $200,000 to $250,000 range, where anything like that anywhere in the United States, especially in the more desirable regions in the United States, would be probably $400,000, $500,000, $600,000 or more. That's one huge benefit. Your money gets you further. Now, the detriment is the more exotic you get in the markets that you're considering for your investment, the more the risk is increasing that the countries may not be very stable. As you know, if you look around and you do a little bit political research, you will find there are countries that have been traditionally very stable, but there are also plenty of countries where the political environment and the economic environment is very unstable. I just recently had a great conversation with somebody who not too long ago came back from Argentina after having gone there for graduate school. And she basically told me they have two economies, the normal domestic economy, and they have, I think, a peso or something like that as the currency, but it's worthless. The inflation is horrendous. The peso is constantly losing money. They had already 3 reforms where they basically said, okay, the exchange ratio for the peso is so high now, we're just cutting it 10 to 1 or 100 to 1. That happened in the 70s and I think in the 90s again, and then something like 2010, and they're not very far from it again. So what are they doing? They have a second economy where everybody pays in dollars, which is fine when you're coming to the country in dollars, but it's much more criminal and corrupt because there's no real control of where the dollars are coming from. Are they really actual dollars or are they fake and all this kind of stuff? Now you have to ask yourself, do you really want to invest in a place like that? And I'm not saying this is only Argentina. There are plenty of places where you don't necessarily know, is it a good place? The other thing is, what are your rights as an investor? If you're actually buying something, do you have rights so that the government can't just come along and say, okay, well, we have changed the rules and now anything that people own is going to be government owned. If you say, well, that could never happen. Oh yeah, it can. I know of a pretty horrendous story in Africa, in an African country that was actually on a good trajectory in development and had opened up so that people could actually start owning land and owning property and owning houses. And then they had an election, corrupt election that might not surprise you. Basically, dictator type person came into power, and to secure the power over the normal term of the election, he got enough people and the military behind him and passed laws that private ownership was suddenly no longer allowed. And that wasn't just for houses that you would live in, it was also for farms and all kinds of stuff. They introduced socialism. Now you wouldn't want to invest in those places either. So that's kind of like the bad side of the coin. But there's also a good side of the coin. For one, there are stable places, like for example, one that I know that I've visited myself would be Panama. That is actually pretty attractive. Or there are places that used to be British colonies in the Caribbean and other places where the prices haven't increased. You have a stable economy, you have a stable government, you have stable rules, you can invest, you get a real title, just like here. The only difference is that the prices are not as high as we have seen them become here. But then there's also another thing, and that is something that I'm always a little hesitant to speak about, and that is the political environment and what's going on here. With this increasing inflation, when you ask yourself, what is the demographic change that we're seeing, and you will see around yourself, if you are my age or maybe a little younger, you will find that more and more people are reaching an age where they're actually considering to retire. And I have always said, to develop the passive income portfolio, one of the purposes is that you can get to early retirement. That's actually why in our Ideal Investor Show, in our podcast, we call it the path to early retirement. So it's not waiting until you're 65 or 67 or 70, but getting to that point where you have enough income coming in so you can retire is earlier than the traditional retirement age. And so if that's the case, then the question becomes, okay, if I can reach this at 40, 45, 50 or something like that, where would I live? And you want to live in a place where the money that comes in carries as far as possible, where you get more for your money than you might get in the United States. And right now, anybody who makes actually a good income, a good passive or active income, is faced with potentially more and more taxes that have to be paid on that income. All these kind of things might be things where you say, okay, well, I'm living currently in an area where the weather isn't so great. Would I want to find a better area in the United States, which is probably expensive, or another place in the world where I have solid ownership rights, where I have a solid government, a solid democratic system, but my money goes farther? And I believe in this whole context of international real estate investing, there is nothing wrong with having a few alternative places that you can own, that you buy for yourself, partially to visit and live there, but also partially to consider to say, okay, when I'm not living there, then somebody can manage the property for me and it can be rented, so it basically pays for itself. And it doesn't take a huge amount of that. You would have an option to leave if stuff really gets bad here. You would have an option to leave when inflation gets crazy here. You would have an option to leave and go to these desirable places when you have more and more climate impacts that might actually make life in the area that you're in miserable, either too hot, too wet, too many fires, whatever it may be. So you want to have alternatives, and that is the biggest driver why you want to actually mitigate the risk that in the area and with your investments all being in the same country, potentially in the same area, you're taking a higher risk than diversifying in many different areas and actually lowering the cost of entry, because oftentimes the properties you can get into are significantly lower in price than what you would have to pay for the same property here in the US. So I hope this is informative. This is a big topic, and there's books written about it and many other YouTube videos. I just wanted to scratch the surface a little bit and give you an explanation why you might want to consider this. And I feel this is really an important topic for anybody who has already developed somewhat of a passive income portfolio and now says, okay, I have 5, 8, 10, 12 properties. Shouldn't I diversify a little bit instead of having everything only in the US market? And I would say, yes, you should. And look at places that you really like, where you would say, I wouldn't mind spending a few months a year there, and then see what you can get there. What's the stability of the system, the rights that you would have if you buy something, and then find the right spot and go and invest. And if you want some help, I'm doing this myself for my portfolio and for our mentoring clients. So if you want some input on what I do and what my mentoring clients do, I'm happy here to help you. So if you're not already a subscriber, I would love to ask you to subscribe. Please give it a thumbs up if you like this video, and tell your network that you heard about it and that we are here to help you out if you want to be a passive income investor. So be well, stay safe, and I see you in the next video.